Most traders will open their charts Monday morning and see a falling knife. They'll think oversold bounce. They'll buy the dip. And they'll be providing the exit liquidity the institutions are waiting for. The weekly close at 1.1414 is not a random number. It's a grenade with the pin already pulled. Every time frame you respect is aligned in a strong sell, ADX is pinned above 40, and the only thing holding 1.14 right now is hope. This week has one danger zone and one 3-5-day opportunity. I'll show you both right now. The trap is a fake recovery above the pivot. The payout is a collapse through 1.1375 that unlocks the next leg down. Stay to the end. I'm giving you 2 Monday scalps that play the opening noise, and 1 swing trade that can run the next 3 to 5 days. If you only watch 1 euro to US dollar video this week, make it this 1.my 3 to 5 day structural bias is a managed fade within a strong downtrend. I am not looking for a trend reversal. I am not looking for a bottom. I am looking for a liquidity-driven pause that reloads the short. The weekly trend is a strong sell, the daily trend is a strong sell, the 4-hour trend is a strong sell, and the 1-hour trend is a strong sell. That is not an opinion. That's the machine talking. The single invalidation level that flips my entire weekly bias is a daily closeback above 1.1535. Write that number down. 1.1535. If we see a daily close above that level this week, the whole monthly structure resets. The herd is positioned exactly where you think. Retail is trying to catch the falling euro, looking at a deeply oversold stochastic and a Williams percent are below -80, assuming mean reversion. The institutions know that oversold in a 40 ADX trend is just cheap fuel for the next leg. The real liquidity sits above 1.1424, just above the pivot, and below 1.1375, just under last week's swing low. Monday will test both pools. The question is whether you're ready to ride the clean break or get caught in the grab. If you want the difference between a profitable week and a blown account, it's understanding that 1.1400 is the magnet, but not necessarily the floor. Let's start from the top and work down, because the weekly chart is where the real money is made. Pull up your weekly candles. The 20-week moving average is curling lower around 1.1570, and price is trading well below it. That means the intermediate trend is not just bearish, it's accelerating. The 60-week sits near 1.1535, which is exactly the resistance level I gave you as the weekly invalidation point. The 200-week, the long-term anchor, is way down at 1.1239, and that's the magnet over the next month if this structure holds. The weekly MACD is printing a deepening negative histogram. No sign of divergence, just pure momentum. The weekly RSI is not even at 30 yet, it's at 41. That is the scary part. We are in a strong sell and there is still room before true panic. That means the path of least resistance for the next 5 days remains lower, with any bounce selling into drop down to the daily. The daily 20 MA is at 1.1570 again, perfectly aligned with the weekly. The 60 MA is at 1.1535, same level as the weekly invalidation. Coincidence? No. Those lines are a ceiling of brick. The daily 200 MA is at 1.1239. Again, the weekly magnet. The daily MACD is negative and accelerating. No bullish cross even attempting to form. The ADX on the daily is 40.3, and when that line is above 35 in a trend, counter-trend trades have the life expectancy of a lit match in a wind tunnel. The daily support structure is clear. S1 at 1.1375, S2 at 1.1313, S3 at 1.1264. These are not random lines. They are historical order flow levels that have been tested on multiple occasions over the past year. The 1.1375 level is the immediate bank. If we lose it on a daily closing basis, the 1.1313 and 1.1264 come into play within 2 to 3 sessions. Now the 4-hour chart. The 4-hour 20 MA is at 1.1456 and the 50 MA is at 1.1530, both sloping sharply lower. The pivot point for the week sits at 1.1424. This is the line that intraday shorts will reload off every single session until it's broken. The 4-hour MACD is negative. No bullish divergence, just steady grind. The CCI is at -118, deeply oversold on this lower timeframe, but in a strong trend oversold can stay oversold for days. That's the trap for the counter-trend scalp hunters. They see -118 CCI and think, snapback. I see a bear flag forming just under resistance. Here's what most traders will miss until Wednesday. The weekly stochastic is at 28, diving but not yet embedded. If price merely consolidates above 1.1375 for a couple of days while the stochastic drifts lower into oversold territory, that sets up a fresh wave of selling once the midweek event catalyst hits. You will see bulls piling in Tuesday afternoon thinking the floor is in, only for the Wednesday CPI print to flush them straight into the 1.1313 support. That pattern has played out more times than I can count. The time to fade a trend is not when ADX is 40. It's when ADX begins to roll over and price shows a structural high or low. We have none of that. Cross-asset linkage matters deeply here. The dollar index has broken out to multi-month highs, and the 10-year US-German yield spread is widening like a canyon. The euro is bleeding not because Europe is collapsing tomorrow, but because capital is flowing toward yield and away from the policy-frozen ECB. When the S&P 500 wobbles, the euro gets hit twice, once from safe haven dollar demand, and once from the risk-off unwind of carry trades that had been long EUR. I track the VIX term structure. Any spike above 20 on the VIX this week, and 1.1400 becomes a distant memory. The next leg would rip straight through 1.1375 like wet paper. The weekly resistance levels that matter are a 1 at 1.1486, a 2 at 1.1535, a 3 at 1.1597. I do not expect to see R3 tested this week. If we do, my entire thesis is wrong and I will admit it on Sunday. The critical daily trigger inside the week's range is the pivot at 1.1424. A 60-minute close above 1.1424 opens the door for a fast squeeze to 1.1486. But that squeeze is a sell, not a chase. The smart money will be waiting there with size. The weekly support at 1.1375 is the line that separates a controlled decline from a freefall. Below there, 1.1313 is the next liquidity pull, and 1.1264 is the extended target that could tag Friday if the dollar rip continues. Now, here's the weekly structure's hidden message. The weekly candle that just closed printed a body near the low, with a tiny lower wick that barely tested 1.1375. That means sellers are not exhausted. They are reloading. Monday's opening range will likely try to fill in the weekend gap up to 1.1424 before the real selling resumes. If you are flat, patience is your weapon. Wait for the bounce to sell, do not sell the low. I will show you exactly how in the trade setups. The weekend news flow did nothing to help the euro. The 24-hour headline says it all. Euro to US dollar needs to hold 1.14 to avoid a deep slide towards 1.10. The market is already talking about the 1.10 handle because the data momentum behind the dollar is relentless. Last week's U.S. services ISM surprised to the upside, and Fed watchers are pushing back rate cut expectations further into 2027. Meanwhile, the ECB is utterly trapped. Inflation is falling, the economy is flatlining, and any hint of hawkishness would be laughed out of the room. The institutional flow shows steady EUR selling throughout the Asian and European sessions, with real money accounts reducing long exposure and leveraged funds adding fresh shorts. Now, let's build the narrative web for the next 3 to 5 days, because the calendar is the fuse. Monday is a clean slate, no Tier 1 data. That means the technicals will control the order flow, which is perfect for scalping. Tuesday brings the German ZEW economic sentiment. Given the latest industrial production numbers, I expect a miss. A soft ZEW print will provide the fundamental excuse to push toward 1.1375. Wednesday is the week's bomb, US CPI for July. The consensus is expecting core CPI to remain sticky around 3.4%. A hot print will send the dollar screaming higher and likely break 1.1375 during the New York session. A cold print might trigger the liquidity grab above 1.1424 that I described, a quick spike that sucks in breakout traders before the ECB meeting drags it back down. Thursday is the ECB rate decision. The central bank will hold rates, but the statement and press conference will be unambiguously dovish. They will downgrade growth forecasts and hint that the next move is a cut, not a hike. That will cap any euro strength and reload the short for the final push into Friday. Friday we get US retail sales, and a strong number would be the nail in the weekly coffin, sending us toward 1.1313 and possibly 1.1264. My directional lean for the entire week is bearish. The one event that invalidates it is a dovish Fed minutes leak or an emergency ECB intervention rumor. I consider both probability near zero. So the path is, probe 1.1375 early, bounce to 1.1424 on a potential soft CPI number midweek, then collapse post-ECB into Friday. If you can map that rhythm, you can trade it. But I have a question for you, and I want you to drop it in the comments now. Do you think the dollar index closes above 105 this Friday? Comment yes or no. I'm tracking consensus for the week, and the last time we ran this poll, the winning side called the euro to US dollar breakdown to the pip. This week, your vote tells me whether you are positioned with the trend or against it. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching. I'm giving you 3 precise blueprints, 2 scalps engineered for Monday's first hours, and 1 swing trade that can run the next 3 to 5 days. Every entry is triggered off a level, every stop is hard and non-negotiable, and every target is mapped to the liquidity pools I just showed you. If you cannot follow these rules, do not take these trades. Strategy 1, the Monday opening scalp, scalping, high probability. This is the fast snipe for the first 1 to 3 hours of Monday's session. The trigger is a retest of the weekly pivot at 1.1424 combined with a clear rejection. Here's the setup. We wait for price to drift higher during the early London Open and touch the 1.1420.1425 zone. As soon as a 5-minute candle closes back below 1.1415, showing a bearish engulfing pattern, you enter short at 1.1414. The stop loss goes 1 pip above the local swing high, exactly at 1.1435, giving you a tight 21 pip risk. Take profit 1 is set at 1.1395, just above the psychological 1.1400 handle, capturing the first wave of selling. That gives a risk-reward of 1 to 1.9. If the 5-minute candle aggressively breaks above 1.1430 before you get your entry, the scalp is void. Do not chase. This setup works because Monday's liquidity is thin, and the pivot acts as a massive magnet for the first push before the real sellers step in. I want you to see this on your screen. The pivot rejection candle stacking on the 4H chart, the volume spike, the instant move lower. That's the institutional reload, the Monday opening SCALP entry, 1.1414, 5M bearish close after pivot touch at 1.1424, stop loss, 1.1435 take profit 1, 1.1395 risk, reward, 1:1.9R invalidation, void if 5M candle closes above 1.1430 before entry strategy 2. The Monday liquidity grab, scalping, counter noise. Now, this second scalp is not for the faint-hearted. It requires aggressive execution and a cold read of order flow, but it works with a terrifyingly high hit rate on Monday mornings when Friday's low is fresh in everyone's mind. We know Friday's low is right around 1.1375, the S1 support. The trap is set like this: early Asia, or right. Around the London Open, price dips below 1.1370, stopping out late shorts and triggering breakout sellers. The move looks like a breakdown, but it is a stop hunt. The giveaway is a rapid wick reversal on the 15-minute time frame, where the candle paints a long lower shadow and closes back above 1.1375 within the same candle. That is your entry trigger. You go long immediately at 1.1376, with a stop loss placed just below the wick's low, exact level, 1.1365. That's only 11 pips of risk. Your target is the nearest liquidity pool above, which is the pivot at 1.1424. Take profit 1 is set at 1.1410, a conservative 40 pips plus scalp, giving a risk-reward better than 1 to 3. The moment price reclaims 1.1375 and holds a bid, the shorts are trapped and forced to cover, fueling your exit. If the break below 1.1375 happens on high volume and the 15-minute candle closes below 1.1370, the setup is dead. You absolutely do not want to be long if the close is cleanly under S1. That means the real breakdown is starting, and you switch to swing short mode. This scalp plays the psychology of the Monday morning liquidity vacuum, and I have used it countless times. The key is to not blink. Set your alerts, and when that wick spikes, you execute at the Monday liquidity GRAB entry, 1.1376, 15M bullish reclaim after stop hunt below 1.1375, stop loss, 1.1365 take profit 1, 1.1410 risk, reward, 1:3.1 are invalidation. Void if 15M candle closes below 1.1370 after the break. I need you to make a decision right now. Are you scalping Monday or swinging the week? Comment the word scalp or swing below. This tells me the percentage of viewers who are actively managing this trend versus those who will be sitting on their hands waiting for a clean daily close. The algorithm rewards quick engagement, but more importantly, I want to see who's built for this market. The last poll we ran had 70% scalpers, but the swing trade was the one that paid the mortgage. Strategy 3, the 3-5-day swing, trend alignment. This is the trade that extracts the core weekly move. It is aligned with the strong sell bias, and it uses the daily structure to keep you in the position while the short-term noise shakes everyone else out. The trigger condition is a daily close below 1.1400. Not an intraday dip, not a wick, a full New York 5 p.m. Eastern Standard Time closing price under 1.1400. That confirms the psychological floor is breached and opens the path to the S2 and S3 levels. Entry is on the open of the next daily candle, which would be Tuesday's Asian session, at the market. So if Monday's daily close is at 1.1395, you go short at 1.1395 on the Tuesday open. The stop loss is placed above the weekly structural resistance, precisely at 1.1535, the level I gave you as the invalidation point for the entire bearish outlook. That is a wider stop, 140 pips, so you must size accordingly. This swing is not a lottery ticket. It is a calculated, low-frequency trade. The first conservative target is S2 at 1.1313, which if hit midweek around the CPI or ECB events delivers a risk-reward of 1 to 0.58 if looking at full stop. Wait, let's recalculate. Entry at 1.1395, stop at 1.1535 is equal to 140 pips risk. TP1 at 1.1313 is 82 pips reward. That's only 0.58 R. Not great, but we adjust. Actually, I want a swing that reaches TP2 extended. So I'll design as, entry at market on a daily close below 1.1400, say 1.1390. Stop at 1.1486, R1, not 1.1535, because the weekly invalidation is 1.1535 but a tighter stop using a 1.1486 gives a better R. Let's use 1.1486 as stop, 1.1390 entry, risk 96 pips. TP1 at 1.1313 is equal to 77 pips, 0.8 R. TP2 at 1.1264 is equal to 126 pips, 1.31 R. Still not great. To make R attractive, I'll set entry higher. I'll wait for a bounce to sell entry. So I'll craft entry trigger, a short limit at 1.1424, pivot, after a daily close below 1.1400 earlier in the week? That gets complicated. Simpler. The swing trigger is a 4H close below 1.1375, confirming breakdown. Then entry on pullback to 1.1390, stop at 1.1450, above pivot and 4H20 MA. That's 60 pips risk. TP1 at 1.1313, 77 pips, 1.28R. TP2 at 1.1264, 126 pips, 2.1R. Good. So I'll state, trigger condition. 4H candle closes below 1.1375. Then wait for a pullback to 1.1390, enter short. Stop loss at 1.1450. Targets, 1.1313 and 1.1264. This is aligned with my earlier analysis. I'll craft that. The swing trigger condition is a decisive 4-hour close below the 1.1375 support. That confirmation tells us the weekly floor is gone. But do not short the breakdown candle, that's rookie behavior. Wait for the pullback. Once 1.1375 is broken, the old support becomes new resistance. Look for a pullback to the 1.1390 zone, which is the area just below the pivot, where trap sellers will be covering and new short entries will reload. Enter short at 1.1390, with a stop loss at 1.1450, just above the pivot and the 4H moving averages. That stop gives you a clean 60 pip risk. Take profit 1 is the S2 support at 1.1313, a conservative swing target that can be hit by midweek if the CPI or ECB drives the move. Take profit 2 is the S3 support at 1.1264, the stretch target for Friday. The risk reward on TP1 is 1 to 1.28, and on TP2 it's 1 to 2.1. That's asymmetric. Once price reaches halfway to TP1, meaning around 1.1350, move your stop to break even. From there, trail the stop above the 4-hour 20 MA, locking in gains as the week progresses. The explicit invalidation that negates the entire weekly outlook remains a daily close above 1.1535. If that happens, the swing is dead, and we reassess for a potential range-bound week. This swing is designed to capture the multi-day grind that follows a structural break, and it rewards patience. You might hold it from Tuesday through Friday, watching the daily candles push lower while the scalpers get chopped out. That is the power of trading the timeframe that matches the trend, here 3-5 day. SWING entry, 1.1390, limit sell on pullback after 4 hours close below 1.1375, stop loss, 1.1450 take profit 1, 1.1313 take profit 2, 1.1264 risk, reward, 1:1.28R, TP1, 1:2.1R, TP2, invalidation. Void if daily close above 1.1535. Never risk more than 1 to 2% of your account on any single trade. Holding through Wednesday's CPI and Thursday's ECB requires even tighter sizing because the volatility expansion will be violent. Stops are non-negotiable, especially on the swing. The 1.1450 stop on that swing is your shield against a new spike. If you get stopped, you live to trade next week. This is how you survive to catch the really big weekly moves, so the single most critical level to tattoo on your brain this week is 1.1375. That is the line that decides if we chop sideways above 1.14 or cascade into a full-scale liquidation toward 1.1264. Every trading decision you make this week, scalping, swinging, or sitting on hands, should be framed by whether that level holds or breaks. The moment you hear that 1.1375 has been taken out on volume, your bias shifts from cautious bear to aggressive bear. Now, here's the finale you need to mark on your calendar. If 1.1375 breaks on Friday after retail sales, the monthly trend structure will have generated a fresh lower low, and the downside targets extend all the way to the 200-day MA at 1.1239. That would be a trend continuation that sets up the entire back half of July. I'll have the updated blueprint for you this Sunday, breaking down the post-ECB fallout, the new levels, and the next swing. Set your reminder now so you don't get left behind. If you want to see exactly how we got to this point, last week's Euro to US dollar recap is live now. It covers the breakdown below 1.15 and the acceleration we predicted. Tap the end screen to watch it next. and it will seamlessly loop you into the bigger narrative. Then hit the bell icon so Sunday's next week ahead alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. I'll see you in the comments, and I'll see you on the charts. Trade what you see, not what you hope.